You asked, so we'll answer. There were too many questions for us to address at our recent quarterly webinar and special bond webinar. Join us as we address the topics that you care about. Hello, I'm Charlie Toole, a portfolio manager at Advisor Investments, and welcome to another Advisor You Can Talk To podcast. It's been a volatile start to the year for the stock market and the bond market. At the end of April, the S&P 500 was down 13%. Bond prices were down nearly 10%, and that has just about every investor frustrated. During our quarterly webinar and special bond webinar, links to each of the replays will be available in the show notes. Participants asked too many questions for us to address in that form, so we're going to hit on as many as we can in this podcast. Joining me today is Jeff DeMarso, our Director of Research. He's responsible for overseeing the investment team here at Advisor, and he's also the portfolio manager of our core mutual fund portfolios. Jeff, welcome.
Hey, Charlie. Good to be here.
Also joining us is Steve Johnson. He's a vice president and portfolio manager. Steve and I co-manage the dividend income portfolio, and Steve is also a certified financial planner that works with clients. Steve, welcome.
We're happy to be here today. Thanks for having me, Charlie.
All right, so we got a lot of questions, and as I mentioned, bonds were down nearly 10% to start the year, so we got a lot of questions on bonds, and that's the first one we'll address today. Specifically, I bonds. Treasury I bonds, are they still a good place to invest at this time? And Jeff, I know you've done a lot of work on I bonds, so I'll kick it to you first.
Yeah, thanks. It's a really good question, and I do like I bonds up to the point that the government lets me like them. So let me explain, what they are and what's good about them and some of their limitations. So I bonds are savings bonds. They're issued by the U.S. government, and they pay a rate of interest that adjusts every 6 months based on inflation. And they were actually supposed to adjust this morning. I have not seen them update their website. I just refreshed the website. Great. So in the prior 6 months, I bonds have paid an interest rate of over 7%. That just went up to 9.62%. That's great. U.S. government-backed bond that's paying 9% interest, over 9% interest. What is not to like about that? Come on, back up the boat. All right, well, there's a few considerations. The first is that you need to buy the bonds directly from the U.S. government via Treasury Direct. So you can't own them in your Fidelity account, your Schwab account, your Vanguard account, wherever you house the rest of your money. Second is that you can't sell them for 12 months. And then if you sell them within the first 5 years, you have to give up a little bit of interest. But again, we're talking 9% on a government-backed bond. That seems tolerable. So both of those I would kind of consider like administrative headaches that you have to navigate around. The really big one, and why I say I like them up to a point, is that you can only buy $10,000 worth of I bonds each year. You can bump that up to an annual total of $15,000 if you're willing to buy $5,000 as paper bonds and hold on to the piece of paper at home, just adding to the administrative work you got to do. So look, if it weren't for those restrictions, particularly that $10,000 limit, we should back up the boat and you should buy I bonds as much as you can. Given those limitations, where I think they're useful, and I've started doing this myself, is building them out as part of my emergency fund. Mm-hmm. Right? It's backed by the government. It's going to increase with inflation, but I'm limited in how much I can buy. And so I'm in the process myself of just going $10,000 a year. I'm not bothering with the paper bonds. It's kind of a step too far for me. But spending a few years building out and transitioning my emergency, my rainy day fund, and moving it over to I bonds. And I think that's kind of a good use of it, given that you've got that cap in terms of making it hard to move the needle in your investment portfolio.
Right. And Steve, more on the financial planning side, and we did get a question about this, is where do you keep your safety money? And most people, or my advice is keep it in a place where you can easily get it. This is certainly one of those areas. And to your point, you're earning a lot more with the I bond than you would be in a CD or in a bank savings account.
Yeah, and that's why I'm willing to make a bit of that hassle of doing it over a few years. Because again, when you first put it in, it's locked up for 12 months. That's not your rainy day fund anymore because you can't get it. So yes, I agree. For that rainy day safe money, it needs to be accessible. and you want it to be, I'm going to say, low volatility. For some people, that might mean no volatility, and that might mean a CD. It might mean cash. It might mean treasury bills where you know you're not really having any volatility. But also, maybe you're willing to accept a little bit and use something like an ultra short term bond fund, right? Do you need your rainy day fund to be exactly making it up? $15,000. Does it have to be $15,000 day in, day out? Or if it's down 14,800, is that okay? Is that still going to cover your emergency? And in that case, maybe you can go to something like an ultra short term bond fund and try and pick up a little bit more yield. But you don't want to be cognizant of just the risks and what that means. And again, to your point, it's financial planning. How much of a rainy day fund do you have? How much of an emergency can you cover? Can you pull from somewhere else if you need a little bit more? Yeah, again, the financial planning. This is the core of the foundation of your plan, really.
Right. And Steve, what do you, as a financial planner and working with clients, what do you recommend for your clients to keep in that sort of rainy day, easily accessible pool of money?
Yeah, and it really depends, Charlie. I mean, I think every client's situation is different, so it's difficult to have just a general rule of thumb. But we advise having 12 to 18 months. And I think now it's you can actually make that case even more strongly as opposed to last year. And I think to Jeff's point, this is pretty amazing what we're talking about here. If we were doing this podcast last year, we'd be scratching our head going, "Gosh, I can get maybe 0.10 on a treasury. My cash is zero, and so that's why we had everyone talking about putting it in alternatives and looking at stocks. But now you can buy a 1 year treasury at 2%. A 2 year is at 2.71 this morning. I mean, pretty extraordinary when we think about the income that people can now get, even on the short end and for their emergency funds. So it really has changed the landscape, I think, for investors in the fact that there is now a place for them to put money. As Jeff mentioned, either I bond or even real short-term treasuries, you're getting a return now.
And that's good. That's because, as you said, a year ago, you would just, that was almost like cash under the mattress. And speaking of cash, we had a lot of people asking, is now the right time to go to cash? Should I hold extra cash? Should I just stay in cash for the rest of the year with the markets and even bond markets down to start the year? So is cash, should that be where investors move their money? Jeff, I know how you feel about this, but I'm going to I'm going to let you go first.
All right, yeah, I'll go first. And Steve, round me out a little bit here. This is kind of a bit of a market timing question, right? Should you be in
Absolutely.
cash? So, are you pulling from your stock portfolio? Do you think cash is going to do better than stocks? Are you pulling from your bond portfolio? Cash going to do better than bonds? And I get why people are saying this. As you said, stocks had a rough first quarter, rough first 4 months of the year. Bonds absolutely had a rough first 4 months of the year, and that was on top of a negative 2021 for bonds. So I certainly get the frustration. But as Steve pointed out, you're now getting more income from your bond portfolio. Some of the damage
Mhm.
has been done. So now you're earning more income from your bonds, which means that you're either getting more income, or if you're reinvesting, you're buying more shares of your bond fund at lower prices. And as we talked about in both podcasts, bonds have this self-healing feature where they mature at par. So at a certain, what that means is that at a certain date, the maturity date, the borrower is going to pay you back in full. So you know exactly what that bond is going to be worth at a future date. So I think that bonds still have this role in the portfolio, helping to offset equity market risk. And I know it hasn't felt that way in the first 3-4 months of this year. But that doesn't, I still think and have confidence that that's going to play out over a longer time period of 12, 36 months, 5 years down the road. And so I'm going on here, but it comes back to that financial planning question. If you have your rainy day fund taken care of, if you have your immediate spending needs taken care of, well, we're talking about your investment portfolio, which should be measured in terms of years, not in terms of months or quarters. And even though you are getting a bit more income on your cash, you can still find higher yields and hence better returns on bonds over time. Again, assuming it matches up with your time horizon. Steve, help me out here.
Well, no, no. It's funny, Jeff. I'm going to agree with you mostly on this. I do think there is a role for those people and those clients who are perhaps don't have the strength to hold in the whole time and are looking for a little bit more of a tactical solution. And albeit there are probably it's not for everyone. In fact, it's probably a small number of clients, but there are those out there who really just have a low tolerance for loss, don't understand what's going on now, and perhaps a solution that is more tactical, that has the ability to be more reactive to the market, go to cash, be able to have more of that as a safety. There's clearly room for that in a portfolio. And I think here at Advisor, we offer several of those solutions, especially on the fixed income side, for those clients who are perhaps, really in need of this cash and aren't willing to lose as much. And so there is a place for that. But to your point, the bond side right now, my gosh, I mean, if you're a bond investor, you've got to be you're so excited. I know it's short-term pain and it's terrible that you're looking at your portfolio, but I've got a meeting this afternoon with a client and who asked just that question about their individual bonds, and they're showing 6, 7, 8% losses in those. But as I'll point out, they're going to mature at par. So that loss that they're seeing now is not going to be a loss. And the hard part is just being able to see through that. But in the meantime, all of a sudden your income has gone up, threefold here in the last couple of months as we've seen that. So actually, I'm rooting, get it over with. Let's get that 2-year up to 3%. We'll see the 10-year at 3.5, and then people can buy as many bonds as they want, because as we know, at some point that does become an option for investors, and it does compete against perhaps stocks. But no, I think you're right, Jeff. I think the argument for cash with the markets down as much as they are now is clearly not as good as it was several months ago. And right now, actually, there are parts of the market that are attractive. And I think, you know, we've talked about this for a long time, and the theme of our podcast over the last couple of years has been, kind of stay away from that excessive speculation. And it was hard last year because everyone made money. And now, yeah, the market's down 12%, but as we've seen, those areas of speculation are down a lot more. And I think that's an important point, is that, yeah, markets have been down, but really, if you're diversified and such, it hasn't been as bad as if you were really concentrated in those areas.
Yeah, Steve, that's great. I just want to pull on 2 points just to reemphasize them. I think on the tactical side, you're absolutely right. Being more reactive makes sense for some clients. And what's great about our tacticals, it's disciplined, right? It's not just going by the feel of your gut. Oh, let's put our finger in the wind and go cash here now and all over here the next day. It's disciplined. That has a process. It's designed to get you in and out of the market. And again, I'm going to say it again, a disciplined way. And we think that's different than just jumping all in and out based on how you're feeling when you wake up one morning. So I completely agree on that. And yeah, your point about being diversified, some of the headlines, particularly around tech stocks and the NASDAQ, there's a lot of damage there. But chances are, if you're a diversified investor, uh, take a look at your portfolio. You're probably not happy with it, but it might not be as bad as some of those headlines look.
And one more point I'll make with the tactical is it's a piece of a client's portfolio. And Jeff, I think you said, Jeff, not all in, not all out, and that's how we use it. It's a small piece that can take down the risk a little bit of a client, and it's not all in the market or all out of the market. It's not a binary decision. It's a diversified piece of the client's overall accounts.
Yeah, I think that's great. I mean, look, the three of us are going to finally round out tactical together, and it's designed, as your point, as part of your portfolio. There's a real emotional cost to being all in cash or all out of cash. I think when you're all in cash, it might feel safe, but as the market's going down and feel good, but it's really hard to get back invested, either as things go down or when they start rebounding. It kind of takes this emotional toll for a lot of people, just seeing the market not coming in and out. And again, that's why we run it in a disciplined way that's meant to take emotion out of investing.
And I think one of the benefits that we have so far this year with the losses, not that we want to see losses, but we can harvest those losses in taxable accounts. And I think, there were a few questions: should I sell my stocks? Should I sell my bonds to take these losses. And we have been doing that. So I think the default answer is yes. But Steve, from a financial planning aspect, what's the benefit of harvesting those losses?
Yeah, it's a great question, and it's probably one of the, well, I guess you can say it's a positive out of a negative, right? I mean, we don't like to have losses, but what we found last year is that the market's gone up for a very long time. And people were calling this year saying, Steve, I can't believe I've got to pay estimated taxes now because I've made so much money over the last couple of years. And folks didn't have to take their RMDs. So there was a huge issue around taxes that we've seen in the last couple of years. So this year, early on, what has been great is yes, we've been able to harvest some losses. And with so many different funds that are out there and so many different ETFs that are just different enough so that you can avoid what's called the wash sale, investors have a lot of options. And so yes, to be able to take a loss either in an individual stock now, buy something that's in the same sector that will perhaps act similarly for that time period. That's a good strategy. But even in the bond piece, there are different, obviously so many different types of bonds. But being able to take that loss and then what you're able to do at the end of the year, we can take a look at kind of if there are gains to offset. And because obviously, if you're buying stocks now, odds are pretty good that a year from now you'll have some gains. And so, being tax aware could really help you next year when you have to go do your taxes.
And one thing, I just want to clarify one thing you said, the wash sale rule. When you sell a security and take that loss, you can't buy it back for 30 days. So you have to stay out of that security. But as you said, there are a number of different substitutes, whether it's funds or ETFs, where you'll be able to find, as you said, a like security that gives you the same experience. If you sell the S&P 500, you can buy the Russell 1000, which is going to give you a very similar investment experience, and that'll allow you to remain invested but capture that loss. So I think one of the other questions, Jeff, I think you mentioned self-healing for bonds. Obviously a bond matures at par. There were a number of people asking, does that self-healing philosophy also apply to bond mutual funds and bond ETFs?
It absolutely does. Maybe not if you own long treasury, the long treasury fund, and it's not going to own that bond to maturity because it's supposed to just own the longest treasury, so it's kind of rotating through. It's going to be a little bit different, but fundamentally, it does play out the same way, and that's because your bond fund owns bonds. Right? If the bonds themselves, if their prices are healing, well, it's going to funnel through into the price of your mutual fund, and it too is going to heal. And I think a great example of that is looking at it from the other side of the equation. And that's saying when your bond goes up in price, so yields fall, your bond goes up in price, goes from 100 to 105. That's great. It feels good. But guess what? They're still only going to pay you $100 at maturity. Right? So in that case, your price is actually kind of getting pulled down. So if you take a look at something like Vanguard Total Bond Market Index, and you look at it from 1990 to today, and so this is Vanguard, it's index fund of just high quality treasuries, corporates, mortgage-backed securities. And you look over the past 30 or so years in this period of falling interest rates and quote unquote rising bond prices, well, that fund's NAV is traded pretty much between 9 and 11. So it's kind of bounced a bit around 10. So the price return's only been about 20%. And what's supposed to be this big bond bull market, well, pretty much all the return, the fund is up over 400% over this period, is come from the interest that you've earned. So there's a case where you own a bond fund and you're still kind of being impacted. Its price over time is being pretty stable as bonds, the prices go up and down, but eventually they do get pulled to par, pulled to that 100. And again, it's really that income and reinvestment of income that drives your return, not the price on bonds.
Couple of questions on increasing risk or buying the dip, if you will. So, the basic question is now a good time to buy some solid stocks at depressed prices? Or do you think the market has a lot more downside? Steve, I know you have a crystal ball, so you're able to answer this one, but
Well,
go ahead.
yeah, no, Charlie and Jeff, this podcast would be 2 days long if you kept allowing me to talk, and I probably have 17 different opinions during that time frame because I guess the question of that goes back to the planning piece of it. We stress when we do every financial plan, what is your needed rate of return, right? And so, unfortunately, investors have been taken by, you know, the excess returns, I guess, in some names over the last couple of years, and people have risked. Maybe taking a little too much risk. And what we've seen over the last couple of months is just this re-rating. So how much are investors willing to pay for kind of growth? And what we've seen is that some pretty large declines in some of those most popular names, whether it be the big drawdown that we saw in Netflix or even Amazon on Friday. These are names that everyone, if you asked in your neighborhood, if anyone talked about stocks, even for investors who didn't do a lot of investing, what stocks did you own? And they would tell you Netflix, Facebook, Tesla, Amazon. We could talk some AMC or GameStop and obviously crypto. Well, what people have realized that maybe I need to be a little bit more diversified. And so, should you buy this dip? It depends on your situation, but from what we look at on the broad market, we've seen a lot of damage already. You've seen a lot of damage in large cap growth stocks. You've seen it in the smaller growth stocks as well. And on the flip side, you've seen things like utilities, consumer staples, those do very well. And at some point, this rotation that we've seen, where everyone has gravitated toward the kind of what are perceived as safer stocks, they will reach a point too where they will become probably overvalued. And those technology names, they then have an opportunity. We saw this in 2000 to 2002. Coming out of that, we saw that investors changed, and so we like to say it's time in the market, but now is an opportune time to kind of to look at the portfolio and to perhaps rebalance. Some of those names that you owned have done very well on the defensive side, and that may continue again for another month or two. We don't know. We do know the Fed is raising interest rates this week and probably next month as well. But things will change again. And so that's why it's so important to remain balanced and diversified, but take advantage. I think, we don't advocate people be all in, as Jeff said, all in or all out. But right now is a great opportunity to rethink your portfolio and reposition and rebalance, take advantage of some of these weaknesses and some of these kind of, I would say, these real big movements that we've seen over the last couple of months.
Yeah, Steve, I agree on that. About it depends on your time horizon here. Is it a good time to buy for the next month, 2 months, 3 months? Oh, who knows? I mean, Charlie, you joked about the crystal ball, but longer term, absolutely could present some interesting opportunities. And your point about rebalancing, it's not doesn't mean you have to go all in on one sector, all out of another sector to take advantage of what you might perceive as opportunity.
Yeah, and I did joke about the crystal ball. I think the long term crystal ball is clearer than the short term. To your point, so if you've got a long time horizon, some of these stocks, as Steve mentioned, are depressed, and if you're looking 5, 10 years from now versus 5 months from now, a lot more confidence that the market's going to be higher 5 or 10 years from now than over the next 5 months.
Yeah, and I think there's an important point to make here about some of these stocks. Let's take Netflix because it just had, big, whatever that was, 35% one day drop, and it's down 65% from its all-time high. Netflix has been through three other drawdowns of 60% or more. And over that, since its IPO, and over that time, it's up some, I don't know, 10,000 plus percent. So, point being, even if you look back and said, oh, this was a great stock, this was a huge winner, no brainer decision to buy it. Why didn't I do that? Even if you did make that obvious in hindsight decision, it would have been really hard to stick with it through time. So I think that's a know underappreciated fact of owning stocks is that it's a regular occurrence that individual stocks, markets to a lesser extent, they tend don't go as big a magnitude of decline, but even markets have large drawdowns regularly too. and it's more a feature of investing in stocks than a bug, I would say.
That's a great way to end, is that stocks have volatility, and just make sure you're comfortable with that, whether you're increasing risk or holding stocks in general. All right, Jeff and Steve, thank you for joining me today. This has been Charlie Toole, Jeff DeMasso, and Steve Johnson from Advisor Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe and review our show. You can check us out at advisorinvestments.com/podcasts. Your feedback is always welcome, and if you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. Before closing, I'd like to thank Kaylee Steele and Ashlyn Melvin. They do all the hard work making this podcast possible. Thank you for listening.